Good morning to one and all. This is Dr. P. Lavanya, working as Associate Professor in MBA Department in Aeronautical Engineering, Dundigal, Hyderabad. Today our video topic relates to the definitions and the terminology relating to the pricing strategies. So in this video we can see what are the different types of definitions comes under the pricing and what type of terminologies or the strategical words we can use with its explanation. So firstly we can see define pricing strategy. A pricing strategy is an approach of business used to determine what prices they should charge for their product. Means it's an approach or a plan how much price we should charge for the product and services. It involves in analyzing the market, customer demand. It involves analyzation of the markets, customer demand and understanding the customer needs, evaluation, production cost and setting competitive prices that maximizes the profits. So we can say that pricing strategy is a plan how we can determine a price of the products and services. While determining its price, we has to take into the consideration of market conditions, customer demand, and we also analyzes the customer need evaluation and what type of costs are involved in case of production of the goods and services, and external marketing competitors should be identified in order to attain the profits. So the analysis of all these factors to be taken into the consideration in case of pricing strategy. Explain economy pricing. Economic or economy pricing, it is a strategy for assigning the prices to the product based upon their production cost. Economy, we can say it is like lesser cost or economical, means we used to identify that considering or cost factor is to be considered. So here assigning the price of the product based upon the production cost means internally we have the labor, land, labor, raw materials. So based upon their cost of manufacturing, the economical pricing will be there. So it may be familiar that the economy pricing, it works in the sales or financial departments of the business that sells the product. Means familiarly we know that working in case of sales or financial department people mainly use this economical pricing. Means they take into the consideration of internal production cost. Based upon that the price of the product will be given in the market. Define penetration pricing. Penetration is a marketing strategy which is used to attract the customer to a new product or services offered by lower price during the initial offerings. Means penetration, it is like going deeper into the market. So once when we want to catch the market segment of deeper level also, so in case of a new product which was introduced in the market, at the time the producer will use at a lower price in order to attract the customers or in order to make availability for all customers to purchase. So this type of offering the product at a lower price at its initial stage calls as a penetration pricing. What is price skimming? Price skimming is also known as skim pricing. So it is the pricing strategy where the firm charges high initial price and gradually lowers the price to attract the more sensitivity customer. So where we can say skimming is an opposite to the penetration pricing strategy. As in the skimming, first attempt was to give the product at a higher price. Means initially the product will be launched at a higher price. Then afterwards, once the product was gaining its reputation in the market, in order to make available to the all types of customer or price sensitivity customer, it was given at a lower price after the initially introducing of the price. Means in skimming price, higher price is given at initial stage and gradually decreases its price to attract the customers. What is psychological pricing? Psychological pricing, it is a phase of its own or describing in a business practice in order to setting the price lower than a whole number. Means psychologically means attracting the customers, means where it says that first we go for setting at a lower price by counting the number or by understanding how many people are attracting to the lesser price, then we go for increasing of the price. Means psychologically first we make the customer to adopt to purchase that product. Once the product was started purchased by the consumers, automatically they follows the purchasing pattern. So this type of making the people psychologically adopted to a product is called as psychological pricing. What is a product line pricing? Product line pricing is a pricing strategy where a company offers a range of product or services at a different price points, with each product having a distinct set of features or benefits. Means it's a line, means a group of products where we can say like a product line pricing. So the company want to give wide range of products and services. Means a single product is not offered by the company. The company will provide 2 or 3 products or more products at a different pricing. So this is also called as bundle pricing. A group of goods or services are offered at a one price, where the products itself is having some different or distinct features or having some additional benefits. So this type of pricing we'll call it as product line pricing. Define pricing variation. Pricing variation is the actual unit cost of an item lessen its standard cost multiplied by the quantity of actually units purchased. Means here the price variation is relating to the differentiation or the change we can see in case of unit cost of an item. When its standard cost is multiplied, means already we have a set cost, that is standard cost is already set. So when it is having multiplied with the quantity of actual units purchased, then we can identify the differences between the actual unit cost and also the standard unit cost, which we'll consider as a price variation. Define initial maximum price strategy. So if the initial maximum price strategy is also, we can say like the price skimming of a product, where the pricing strategy by which changes the highest initial price, then customer will pay, then lower it's over the time. Means it is like a skimming pricing strategy where the organization or firm charges higher price at initially when customer was adopted to it, and automatically it lowered its price. So this type of pricing we used to call as initial maximum price strategy. Define introductory low price strategy. Introductory low price strategy, it is an approach which is aimed to attract the customers or the consumers when you want to offer any sort of new product by a special price, creating a new customer audience for the new entry. Means the customers are also new here, the product is also new, firstly a freshly launched product, and attracting of this new customer is done by giving a lower price, that is called as introductory price strategy. Means when we want to launch a differentiated product first time to a differentiated customer, this type of pricing means low pricing strategy is followed, called as introductory pricing strategy. What is geographical pricing? Geographical pricing is a practice in which the same goods and services are priced differently based upon the buyer's geographical location. Means here nothing but based upon the area wise, location wise, the goods and services are priced differently. Means different price was charged based upon the location of the consumers or the buyer's geographical location. Means maybe we used to identify that the prices where in the villages will have some sort of pricing, and towns, cities, based upon the location of the geographical place, the pricing will be different. So that type of pricing we'll call it as geographical pricing. Explain price discounts and allowances. So the incentives which are used to motivate the sales are called as discounts, while those are used to motivate the payments are called as allowances. So here price discount and allowance. Discount is a sort of offer which makes the consumer to purchase the goods, giving some sort of offer or incentive or maybe decreasing the price. We'll call it as discount. Means price reduction given to the customer upon the goods and services are called as discount. When this was motivated for payments are called as allowances. Means this makes the customers to pay to the purchasing of that product, then we'll call it as allowance. Explain price allowance. Here discounts are the most oftenly used by the retailers, where the wholesaling companies when the stores holds at a sales. Means here the price allowance is given for the wholesalers, where the retailer will utilize this allowance and provide some offer or sales. So when we can see an example that when a store gives as a 10% offer of sale. Define promotional pricing. Promotional pricing is a sales strategy in which brand temporarily reduces the price of the product or services to attract the prospects and customers. Means promoting of any sort of brand or any product means to getting a good promotion in the external market. So the pricing strategy will be evolved. So they are temporarily means in order to make availability of the product or make the people to know that brand. So these companies will promote by giving a lower price or offers upon the price, such that the consumers or the people will be attracted from the market. So this type of pricing which make through ads or providing discounts, wide publicity, that type of pricing we'll call it as a promotional pricing. What is a discriminatory pricing? Price discrimination is the selling strategy that charges the customers different prices for the same product or services based on what the seller thinks they can get from the consumer to agree to it. Means discrimination is in a strategy that having a different price to the different customer based upon the product or services. Means customers are charged with a different price to the same product, but when the seller think that the customer is agreed, means once the customer accepted, then the differentiated pricing will be taken into the consideration. Means discrimination will be given to the customer based upon the product or services what he want, but the agreement or agreeing of the consumer is most necessary in case of discriminatory pricing. Explain FOB factor pricing. FOB factor pricing, it is a strategy that only one in which the seller does not pay any of the freight cost. The delivery price of the buyers varies quotes according to the freight cost. Means factory pricing or FOB pricing, that what we'll call like where the seller will get a discount upon the freight cost, means the delivery cost or the freight getting cost will be given discounted for the customers. And when these delivery price to the buyers varies according to the freight cost, means the based upon the charges provided for the freight cost, the customer will give various types of discount upon FOB pricing. So here, based upon the freight cost determined by the producer, the FOB price will be charged. What is uniform delivered pricing? This is a pricing method where the as referred as postage stamp pricing, in which all customer pays the same freight cost regardless of their distance from the dispatch point. Here it is FOB pricing. We can have a differentiation between FOB and uniform. FOB is where the delivery charges or the freight costs are changed according to the customer place or type of cost. But here, uniform delivery pricing, totally whatever the area or whatever the distance, but all will get equal freight cost or postage stamp cost, means uniformly irrespective of the distance of delivery, all will charge the same price, which we'll call it as uniform delivery pricing. What is price discrimination? So the price discrimination is simple, that the seller charges different prices or different fee for same type of product and services to the same consumers, means it is discrimination or differentiation in the price to the customers, different customers for the same type of product or services. Define cost plus pricing. So this is a common pricing where all business people will use. Cost plus pricing is a pricing strategy in which the selling price of the goods and services is determined by adding fixed markup percentage to the singular product unit cost. Means here the cost plus pricing is nothing but first we'll add the total cost of the product. So with this total cost, already the company will have some percentage of profits. Additioning of percentage of profits means total cost plus some percentage, that we'll call it as fixed markup percentage of profits is added and introduce the price in the market, which we'll call cost, that is total cost plus some percentage of the profit. We'll call it as cost plus pricing. Explain transfer pricing. Transfer pricing refers to the rules and the methods for pricing transactions between the enterprise under common ownership or control. So when we have a branches or when we have a different, in case of MNCs where we have different branches in different nations, when the price, the rules, regulations or methods of the pricing in case of transaction between the same enterprises, means transfer to the one branch to the another or one enterprise to the another, but all these enterprises are under one ownership or under one control. So this type of transferring the prices from one enterprise to the another containing the control is under the hands of one, call it as transfer pricing. So these transfer pricing is based upon the market prices in charging another division, subsidiaries or holding companies for services rendered. So as transfer pricing is based upon that, maybe it is given under to the same type of ownership, but there is some differentiation based upon the market pricing, maybe the subsidiaries or holding companies, what types of services rendered. So there will be a slight change in the price due to the additional services rendered by the other branch of the holding company. So once the rules, regulations, methods will be common for all types of enterprise, but only a slight change in the price will be taken place in the transfer pricing. What are behavioral theories? So when you comes under the theories of the firm, so the behavioral theory seeks to explain the human behavior, analyzing the incident and consequences presented in the individual environment and learned associations he or she has acquired through previous experience. So here the behavioral theory is nothing but which has been given an analysis or explanation of how an individual behaves in an organization or firm. So his behavior will have some sort of previous and past, maybe present, past and future consequences related to the environment, that is individual environment where he has learned up or brought up, given training, means where he himself has been associated. So based upon his previous experiences, his act or his behavior is considered as behavioral theories. Means analyzation of the human behaviors based upon his experience of past, present and future involvement, considering the environmental factors to his working nature in an organization, is called as behavioral theories. What is dumping? Generally, dumping means to call as international price discrimination, when the differentiation in the price will be taken place rather than the home country to the external country, then this is called as international price discrimination, means differentiation of the price to the home country to the other country, where the prices of the product when sold in the importing country is less than the prices of the product in the marketing of exporting country. Means here the international price discrimination explains that the prices of the product in the local country will be high, but when we export the same goods to the another country, there the prices will be less. Means the excess production or increased production will be dumped into the another country through exporting. So this process is called as dumping, and the differentiation where the home country or internal country will have higher price and exported country will have lower price is considered as international price discrimination. What is the meaning of anti-dumping? Anti-dumping duties or taxes. Anti-dumping means some taxes or the duties which are layered upon the imported goods in order to compensate the differences between the exported price and their normal value. Means when we have to import the goods at a lower price, what we are having the same goods at a higher price in the country, to equate both internal and external imported country prices, the government will charge or add additional taxes or the duties to the imported goods. Means importing from the other countries, maybe we have the prices of onions 50 rupees in India, maybe when we export that for 35 rupees from external country. Here the Indian government will charge some anti-dumping duties, maybe related to the 14 or 15 rupees, such that both the internal and external dumping, totally the price will become as a 50. So this type of normalizing the price between the imported goods and the internal goods, will call it as anti-dumping. Here, if dumping causes injury to the producers of competing the product in the importing country. So why this anti-dumping duty was imposed means the importing of those goods should not cause any sort of injury to the competing products which are within the country to the imported goods. Means the local producer should not suffer. That's why the dumping goods will be added some sort of taxes which in the process of anti-dumping. So this is about the anti-dumping duties. Next, what are exports? So exports are goods and services that are produced in one country and sold to the buyer in the another country. Means the goods which are produced in the external and selling into the another country, we'll call it as export. Then what are imports? An import of goods and services is one country producing in another. Means maybe we'll produce the goods and we'll sell the getting the goods from another country. Means exports or getting the goods of external countries product to one country, means our country. Maybe getting goods from America, we are getting the goods to India, then it is called as importing. Yes, so importing of the goods means here the goods and services where we get from America to India. So the policy which we come across, importing and exporting, means in the exporting our goods were sold to the America, means Indian goods are sent to the outside and outside goods are comes to the India in our country, that is called as imports. So the Indian government is having a policy called EXIM policy, import and export policy, which we'll call it as EXIM policy, where it lays the rules and regulations relating to the importing and exporting of goods and services. What do you mean by BOP? So BOP means balance of payment. So it is a method by which country measures all its internal monetary transactions with a certain period. Means within a one period of time, maybe 1 month, 6 months or 1 year. In that prescribed period where the country will measure its monetary transactions, means money oriented transactions, maybe how much we are exported, money went outside of the country and money went inside of the country. So both to be balanced, then it was called as balance of payments. For example, all will consider, means balance of payments considers 3 types of accounts, as one is current account, next one is capital account and financial account. Means all types of current transactions relating to the imports and exports and relating to the capital transactions, investment, FDI, means foreign direct investment transactions, and also any sorts of financial grants between the other countries with the one country to the another. Means all these has been accumulated and then we used to identify that how much the country's money was went outside and how much the foreign country's money was comes inside. So both to be balanced, what we'll call it as balance of payments in international monetary transactions. Explain about International Monetary System. International Monetary System, which provides the institutional framework for determining the rules and procedures for international payments and a determination of exchange rate and a movement of capital. This is called as internationally financial assessment, where we'll call as International Monetary System. So where the international framework means one country providing the institutional framework such that it will consider or determines rules, regulations, procedures for international payments and how to determine the exchange rate of currency, exchange rate relating to the currency, exchange rate relating to currency. So we have to determine the currency rate international level and movement of capital, means investment through FDI, foreign direct investment and other types of investment, how we can invest it in different nations. So the setting of rules and regulations between the different nations or providing a constitutional framework, institutional framework at international level for payments, exchanging of currency, maybe for investment cadre of related to the FDI is given by the International Monetary System. What do you mean by theory of firm? The theory of firm, it is in a micro concept that states that nature of the company and their existence is to be maximize the profits. Means the theory of the firm related to the individual attainment of a company or organization. Individual in the sense it relates to the microeconomic concept, where these microeconomic concept states relating to the one firm how its existing, its maximizing or existence of sales revenue and how it maximizes the profits, we'll call it as the theory of firms. Explain the different types of theory of firms. So, in order to identify the microeconomic concept of theory of the firm means how an organization individually will maximizes his profits was given in different ways. So, the different types of theories of the firm was neoclassical theory, transactional theory, principal agent theory and evolutionary theory. Means there are the four types of theories of the firm famously called as neoclassical, transactional, principal agent and evolutionary theories. Explain management theory. The Williams management theory was propounded by Williamson in 1966, suggested that manager would seek to maximize his own utility and consider the implications of the firm behavior in contrast to the profit maximization case. Means according to the Williamson that we'll get maximum utility means maximum profits by taking the consideration how organization will behave in the external environment in obtaining the profits is considered as management theory. Means management attitude of getting the profits by selling its products in the external market is called as management theory. What is the behavioral theory of the firm? This is famously called as BTF, that is behavior theory of the firm, where it is composition of number of theories that are emerged within the economies, sociologies. Means the theories what are a clubbing number of the people's attitudes, behaviors, changes, all was clubbed with their sociology and economical nature. So which states that the business and management studies to deal the issues how a firm behaves in the market and how it determines the inter-firm relationships. Means behavioral theory was taken how an organization behaves in the external environment by analyzing the various factors like demand, maybe consumer taste, preferences, environment, marketing conditions. So this involves in economy and psychological nature. So with these here the behavioral theory will says that there are certain issues that firms behaves in the marketplace and how it determines the relationship between one firm to the another. That is inter-firm relationships are being exhibited in this behavioral theory of firm. Yes, these are the some of the definitions or the terminologies which we can come across in the pricing strategies. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.